This is podcast episode 10, and welcome to You're 18, Now What? Thank you for joining me on this great Tuesday. I'm Dr. Catherine Gilstein, and I am looking forward to empowering you with information about financial literacy and economic empowerment. I will be posting new episodes every second and fourth Tuesday of the month. Before I get started today, I wanted to address a question that I received from a listener, which I answered by email, but thought important enough to address here. So the question was about paying off a debt that went to collections. So what I shared is that when you make that final payment to the creditor, be sure that it is reflected on your credit report that it was paid. You can request a letter from the creditor stating that the account has been paid in full. And once you receive that letter, you can then reach out to the credit bureaus and alert them about the amount that has been satisfied and ask them to remove it from your credit report. It can take a while, so have some patience. And it can be easy for one credit bureau to remove it, and it could be an all-out fight with another. But don't give up. Keep on top of your report for updates. Any dispute can be handled online through the credit bureau's website. As I mentioned on my last podcast, I'm happy to announce that I will have guest speakers joining me occasionally, and these will be people who are new in their careers, so typically less than 5 years. They'll give us insight to share about their experiences, what they're doing now, what were their expectations, and what they found different for them going into the new role. And we will also cover questions that they wish they knew when entering the job market. So today, thank you for joining me. I am speaking with Sam Mitcho, and he is an advisor with Merrill, and we'll discuss some investing questions. But the first thing I want to hear from Sam. So Sam, great seeing you again.
Thank you for
My
having
first
me.
question to you is about you and your trajectory. So if you think about going from graduating college to getting into your first career, can you walk us through what it was like for you and how you navigated that journey to get where you are now?
Sure. Yeah. So I kind of had a bit of a, interesting senior year, obviously. So graduated in 2020. It was the year of COVID, unfortunately. But thankfully, I had you as a professor, which was great. And you kind of
Thank
pushed us
you.
to get those, of course, pushed us to always get those internships in the summer. So that's kind of what I started out doing. I found myself at a mortgage company, which was very interesting. I guess, Christmas break of my senior year, I actually decided to go out and take my mortgage loan officer exam. So I went and I passed that, fortunately, and March happened, COVID hit, and everybody was kind of scattering looking for jobs. And I thought, maybe I should just utilize this mortgage loan originator exam that I passed.
Why not?
Fortunately enough, it was, interest rates were at all-time lows, selling something that people actually wanted for once, right? People getting in from a 5% mortgage rate into a 2.25% interest rate was pretty exciting to sell. So it was a very high beat market that I was in. I did that for about 2 years. I realized that, I wanted something a little bit more rather than just this transactional piece of, lending that I was doing. It was kind of I talked to a client for 30, 45 minutes. I closed a loan and then I never talked to them again because it was all refinance business. It was all, there wasn't much purchasing going on in my world. At least there was obviously people buying houses and they still are. But I was doing a lot of refi, a lot of transactional stuff. And I love talking to people. That's why I was, so open to doing this. And I wanted more of a relationship building type of career. So I pivoted once interest rates skyrocketed. I made little to no money. So I pivoted and I made the decision that financial advising was what I wanted to do. So I went and I got all of my licenses in about 2 or 3 months. And, having that, and this is kind of basics here, but being able to essentially quit my job and having some reserves on hand, able to kind of keep up with the expenses that I was accruing, was extremely important for me. I wasn't really stressed out at all. I still continued to do what I did during that point in time. So took about 3 months in order to pass all of those exams, and I found myself at a company selling 403B plans, which are essentially 401ks, but for the government sector.
Okay, let me interject you there 1 second. So when you say you spent 3 months getting licensing, first of all, 3 months to get the licensing, and I know about the licensing. That's really, really impressive. So proud of you for that. But can you explain what type of licenses did you go and get, and did you have to have sponsorships for them?
Yes, so I did take a job with a company called Corebridge Financial. They sponsored me to take all of these exams, and it was actually a really good program. And the reason that I passed them all in 3 months was they essentially hired me to pass the exams. So I was working basically 40 hours a week just studying. So this is not something, if you have a day job and you're also studying, it's probably going to take you a little bit longer, but that was my day job. So I was very fortunate. They paid a very minimal salary, but things to kind of keep me going there. I found it to be very, very difficult, but passed everything on the first try. It was the SIE, which is the Securities Industrial Exam, and I apologize if I'm a little foggy on this. That was the first step.
No worries.
A little bit of just basic investing terminology, and then I went and I took the life and health insurance exams, which allow me to sell annuities. And then I went and I took the Series 7 exam, which was an absolute bear. And then the Series 66.
That's definitely a hard one.
Yeah, it was, I was about 10 questions in, and I kind of looked and I was like, am I taking the right test right now? but thankfully kind of bared down and hunkered down. But so Series 7, Series 66, which is essentially laws and regulations, which there are quite a few of. But back to kind of what I was doing at Corebridge, selling 403B plans, which is the 401k essentially for a school teacher, a nurse, something under that sort of umbrella there. And essentially sitting in lunchrooms with teachers, trying to make small talk and seeing if they could, put some funds away, if they have any, disposable income that they aren't necessarily using, and trying to save on some taxes as well as being invested in the market. After that was completed, I realized I wanted something a little bit more. So reached out to a few of my high school friends, which is, it's great to keep your network because, Professor Gilstein, you said it yourself, I never lose a phone number. So
never lose a phone number. Always keep your contacts. You just never know when you're going to run into somebody or, be in their industry or something like that. So definitely great tip there. Always keep your network.
Absolutely. So I reached out to actually one of my old soccer teammates who I found from LinkedIn was working over at Merrill, and it looked like he was climbing the ladder rather quickly. I reached out to him, and he was climbing the ladder very quickly, and the hiring manager happened to be his old manager, who he did very well under. So his word meant a lot to him, and ended up at Merrill Lynch, which I'm very thankful for. Great company, and I have nothing but good things to say about them.
Yeah, they definitely are. Very good company, big company. So definitely a lot of room for growth for you there. I want to get into a couple of questions, and for all intents and purposes, for this call, we can't get into everything because there are a lot of investment avenues. So we're going to go through a couple of questions that are asked from my clients when I speak to them one-on-one, and I'm sure, Sam, they're asked from you. So this first question is, do I understand the investment I am in, and can I get my money out easily? And I think that's a really, really important question, is understanding what you're getting into first.
Sure. So liquidity is And that's what you mean by that, I'm assuming. So liquidity is fully dependent on what it is that you're looking to achieve, really, at the end of the day. Some of my clients need their funds the same day. Some of my clients don't need their funds for 10 years. So that's all going to depend on how we're looking to invest them. Most of my younger clients, I have them invested more aggressively, but that doesn't mean just because you're young that you should be invested aggressively. Like, it goes back to my last point. All depends on what it is that you're looking to achieve, right? So let's say that one of your goals is to buy a house within the next year, right? We don't want to put you in a model that's all invested in equities, which are stocks, which are more aggressive investments. And we see probably, let's say we see a 5 to 10% decline, and you go and you find the dream house that you've been looking for, and you go to get the down payment out of your whatever account, brokerage account, whatever, and you don't have enough money for the down payment anymore because the market's down 5 to 10%. Who knows? And that's just a total hypothetical, but just kind of get you thinking of, it's all dependent on what it is that you're looking to achieve within, I always ask my clients, what's your short-term goal? What's your midterm goal? And what's your long-term goal? What's your nest egg? What do you want your nest egg to look for retirement? So as far as liquidity goes, the market is pretty liquid. They actually are taking the trade date, so the settlement date. And I know I might be getting into the weeds a little bit here.
Of course.
But the trade date used to be you sell a stock, and then 2 days after you sold the stock, the money would be available as cash in your account. It's actually changing to the trade date plus 1 day. So they're actually making it a little bit easier to get your money out of an investment, which is, I think, there's no real con to that. Especially if you have people who are apprehensive to get into the market because they want the funds to be very liquid.
That's great. I think it really ties into the next question, which is when you talk about short-term, medium-term, and long-term goals for your clients when you're speaking with them. The second question is, am I comfortable with the level of risk for this investment, and can I afford to lose money? So can you talk about the different risks for, let's say, stocks, bonds, mutual funds, things like that?
Yeah, and for starters, I don't know if anybody can necessarily afford to lose money in my mind. It's kind of, like you said, it does piggyback onto my previous point there about depending on what it is that you're looking to achieve really at the end of the day. Are you looking to save for a car, which is something in the short term? Are you looking for something in the midterm, like saving for a property, or just simply building up that nest egg for retirement, right? So the level of risk that you're looking to take on, or better said, the volatility, is a huge factor on how you want to be invested. So if you're seeing your account, drop from $1,000 to $950 makes you feel uneasy, then maybe you want to add some bonds to your portfolio. So bonds are, they're obligations from either a company or the government to essentially you loan them money and they pay you back on the funds that you've lent them. There's different types of bonds, and we can get into some municipal bonds if you'd like. I'm not entirely sure. But municipal bonds are essentially, either from a city or a state that you're lending the city or the state money. There's different tax obligations regarding municipal bonds. There's treasury bonds, T-bills, which have different tax implications as well. But all of these provide diversification in your portfolio and really try to kind of alter that or battle that volatility that you're seeing if losing funds isn't really something that you're interested in, or having your funds lose value.
Of course. Let me ask you this when it comes to risk tolerance. Do you think that, because in general, in a general sense, and I know it's all about the person and what their goals are, short, medium, and long term, we spoke about that, but in general, it is the younger you are, the more risk that you can take because you are younger, so you have more time for your career and to make more. So what is the typical, let's say, average split that you would offer your clients? Let's say if they are in their, mid 20s, early 30s, would it be an 80-20, 50-50? How would you navigate that?
Yeah, so I always tell my clients, so I'm kind of on the lines of probably more along the lines of 90-10, 90% equities, 10% bonds. If you are, if these are funds that you are not looking to touch for until your retirement, if you're thinking 401k or Roth IRA, which is a post-tax account that grows tax-free, I would suggest probably 90-10, but again, it all depends on your specific scenario and what it is that you're looking to achieve, really. The stock market is the best place to really be, besides maybe real estate in some years. So in all honesty, yeah, I would say probably 90-10 if somebody my age would come and ask me what to do with their funds.
And I think the key point there is that if you have your funds invested in more riskier avenues on the 90-10 split, these are your earning years. So these are years where you can still go to work, you're still making money, you're not talking to somebody who's about to retire in 5 years, who needs their money as solid, and as steady as they can. So I would definitely tend to agree with you on that 90-10 split for those working years. Another question, can you speak about regulations that are in place for investments? So when I make an investment, are my investments regulated, and how do I know that? So for the new people that are looking to do this.
I'm laughing because it's the compliance, and we kind of went back and forth on what we can ask and what we can't ask. So that's the reason that I am smiling. It's there are a lot of regulations. So there's the Securities Act of 1933. There's the Securities Exchange Act of 1934. There's the Sarbanes-Oxley Act. I have them written here because there's so many of them. Dodd-Frank Wall Street Reform Act 2010.
It's a lot, but definitely it is the SEC. So can you talk about how the SEC oversees those stock market transactions?
Yeah, absolutely. So the SEC really goes into a lot of, they regulate pretty much everything, and it's all in protection of the consumer. So it's all to protect the actual consumer at the end of the day. There's actually an organization called FINRA that really does the overseeing of advisors. But the SEC, they regulate a lot of the, companies. So whether or not your company is acting in the shareholders' best interest. This is kind of a loaded question because there are so many compliance deals and regulations that go into it. But as far as if you are apprehensive as getting into the stock market because you're afraid of what a company might do or what might be doing, everything that they are doing is regulated. Their books they're an open book essentially, and it's all to protect the consumer from putting those funds in and losing it all essentially, because it unfortunately it does happen, but they do their best to try to kind of battle that occurring, really.
Of course. So looking at the investments and looking at the risks and what can be done. So a question that I received is, am I protected if the investment provider or the advisor quits the company or the company goes out of business itself? How am I protected as a consumer that's invested?
Absolutely. So there is something called, so I'm sure that you are familiar with FDIC insurance. So there is something called the Security Investor Protection Corporation, which protects the actual, consumer from losing funds. Again, like the FDIC is insured up to $250,000. There is a maximum that you are protected. It's up to $500,000 is covered by the SIPC is what they call it. Everything is an acronym in this industry. This is different from the FDIC because it does pertain to brokers and not banks. But there is protection if you are, apprehensive of getting in the market and your broker goes out of business or your advisor leaves. In most cases, from my experience, if an advisor does leave, nothing necessarily happens. You just have another advisor on the account. Depending on who it is that you're working with, maybe you like that advisor when they, you like the advisor a little bit more, or you like the advisor less. It all depends on kind of how you're feeling. But as far as if the company that your money is with goes out of business, you are protected up to $500,000, and I believe $250,000 in cash as well.
I think it depends on the type of account you have, and that's definitely something that you can speak with when you have an advisor. So that brings me to the last question that I have for you. So, should I get a financial advisor? So if I'm young and I'm just starting out in my career, and let's say I'm 27 years old and I've been working for 2 years, I have a little bit of money saved. When do you think when is a good time to get an advisor?
Sure. So that's kind of the $1 million question, obviously, and I'm a bit biased on that take, right? I think
Of
everybody.
course, and so am I. But I definitely want to hear your take as a younger individual that's newer in their career.
So I do think that you should have a financial advisor, and I do believe that the earlier you have one, the better, unless you're planning on spending hours and hours doing research and implementing a specific strategy on what to do with your funds to help achieve what it is that you're looking to do. You should always have an advisor working with you. I always recommend to all of my clients that they also work with a CPA. If someone's looking to onboard with me and they don't have a CPA, I usually appoint them one, which I think is extremely important, again, because the CPA and myself can work in tandem and really get a better idea and help the client achieve what they're looking to achieve. And I know that having a CPA seems like something that only adults should have, but realistically speaking, you should always be in touch with an accountant as well as a financial advisor and link the two together, because if you are working in tandem together, you can sky's really the limit there. Having two professionals working in your corner as you focus on your own career path, because at the end of the day, if this isn't something that you're doing as a career, it's not something that you're going to want to pay attention to necessarily as far as the specifics of, what you're being invested in, how much are you spending on, unnecessary taxes, things like that. So
Absolutely. I definitely agree with you there. I don't think you can be too young to have an advisor. I think the misconception of younger adults is that, well, I don't have a ton of money. Why do I need an advisor? Well, you don't want to wait until you have a giant nest egg full of money just sitting in a bank account, in a checking account, earning 0.01% interest. So it is better off to get with an advisor earlier and, see what it is. I spent, 20 plus years in banking and finance, insurance and annuities, but that was a really long time ago. So it's very different than you coming into the field now. So I'm at the point where I know the basics of what you studied when you first got there, but now I'm at the point where I'm looking at, well, what's new, what's changed, what's different. And if you have an advisor and you have somebody who is an accountant who can help you with your tax situation, why not reduce your tax liability? So definitely agree with the points you've made there. Anything else that you want to add?
Yeah, so I always kind of tell my clients, and this is kind of getting into how I run my meetings, but I always tell my clients that at the end of the day, investing is usually about 20% of what I do for my actual clients. So we have which not every company has, but we have a chief investment office with Merrill Lynch. The chief investment office is filled with the chief financial analysts, which is essentially like the bar for financial advising. I am working in tandem with them. I go back and forth with them and try to implement a strategy that's really going to work as far as the investments are concerned. I like to take a more holistic approach, right? So I'll provide a cash flow analysis. How much money's coming in? How much money is going out, right? So
Absolutely.
I like to, focus on that and then inevitably put a plan in place on how we can achieve those goals that they have previously mentioned to me. So kind of like the quarterback on a team, that's the quarterback or the head coach even, really trying to delegate who is doing what to achieve this client's goals and put them in the, as what I say is the most confident place they could possibly be as far as their finances go.
I mean, I think that's great information. Gonna wrap it up here. Thank you so much, Sam, for being here, for your time, your insight,
Of course.
looking at all of this, answering all the questions. And I am sure you will be back on with me in the future because I'm sure I'll get a lot of feedback. So it would be really great to have you, especially as I can watch you navigate through your career. It'll be very cool.
I appreciate it.
Thank you.
Thanks for
Thank
having
you
me.
so much. You're welcome. You're welcome. I'm going to add a few things here. I'm excited to announce my book has been published and it is ready to ship. So, although becoming an adult can be freeing and a blast, thanks, Sam, it can also cause a lot of stress and doubt. So, whether your parents helped guide you about searching for a job, saving, investing money, bettering your credit score, or they just expected you to figure it out, maybe they tried, you just didn't listen. It's definitely not too late to set yourself up for success with the responsibilities that come with living on your own, going out on your own, working on your own. So the book has resources and answers to many questions, whether they're for yourself, your children, other person in your life that might need a little bit of assistance. So just be open to learning, be open to listening, ask questions. What more do you want to know? Visit my website at your18nowwhat.com and drop me a line. Send a question or a comment, and any questions received will be responded to by either email or addressed on the next podcast. Remember, be invaluable for what you share, not what you know. I will see you next time on my website and my podcast. So listen, like, and share. Have a great day, and thanks for joining myself and Sam.